Hi, this is Ray Mignon, and in this video I will explain how our risk-controlled portfolios try to provide consistent income and more stable investment returns prior to and well into retirement. Our process usually starts off with some cash flow planning. Using retirement projections and information provided by you, the client, we determine how much money will be needed to be withdrawn from your investment portfolio each year in retirement. I don't believe most people understand how much money is needed in order to allow them to enjoy their current lifestyle throughout a 30-plus year retirement. In this illustration, the dotted line is showing the overall portfolio value that needs to be maintained in order to provide the desired monthly income stream in retirement. If the retiree is invested too conservatively, say only in bonds or CDs, they may feel safe currently, but in fact, they may not be able to produce enough income in a long retirement in order to meet their monthly expenses. You must keep in mind that your expenses will continue to rise each year due to inflation. Inflation is the enemy of retirees. On the other hand, if the portfolio has too much invested in risky investments, the retiree may lose a large portion of their nest egg in a severe stock market downturn. What is needed is to design an investment strategy that has enough overall growth to generate the needed income, yet has less risk overall. We need to produce the income required every month while producing overall growth in the portfolio in order to stay above inflation. Here is a typical diversified investment portfolio. This is what most financial advisors and brokerage firms offer. The allocations to different investments are static. Yes, they will be occasionally rebalanced back to predetermined percentages, but the problem is there is no consideration to what is going on in the current economic climate when these changes are made, or if a particular investment asset class is way overvalued or undervalued. The automatic rebalancing discipline in these static portfolios will always maintain the same percentage allocations, whether it makes sense or not. And these portfolios usually work well in a long-term bull market, such as we experienced from 1982 through 1999, but usually do not perform that well in a no-growth market such as from 1999 through 2008, where we basically experienced 9 years with zero investment return on the S&P 500. And more importantly, these portfolios performed poorly in severe bear markets similar to what we experienced in 2008 and early 2009, when most asset classes dropped at the same time. If our goal is to provide a steady portfolio return, then we need to include tactical changes to reduce risk at appropriate times and take advantage of market mispricings when exceptional opportunities appear in the market. We also need to include alternative investments that act differently than the market overall. So we think that there is a better way to manage money using risk-controlled portfolios. We build our risk-controlled portfolios with the goal of providing steady returns over all market cycles while trying to limit the large swings in account values. Simply, money compounds better when portfolio volatility is lower. In addition, from our experience, a lot of money is lost in times of stock market stress. During these periods, many investors will abandon their long-term investment strategy if they see large drops in account values each month, even if it's only for a few months. And perhaps just as important, many investors will get carried away in bull markets and not take action at the appropriate time to reduce portfolio risk by selling off overvalued investments. In fact, many investors will chase the performance of the hottest investment sectors and ride those investments all the way down when that particular investment bubble pops. Our risk-controlled portfolios include an allocation to strategic core of stock and bonds. In addition, it includes a core of alternative investments. And the alternative investments help reduce portfolio risk and provide steady long-term returns. Tactical changes will be made to the core portfolio mix for two reasons. The first reason is to reduce portfolio risk when certain asset classes or the market overall appears overpriced. The other reason for tactical portfolio changes is to take advantage of mispricings between different investment asset classes when and only when our research shows that the new opportunity appears to offer more potential investment gains over our current investment mix. And for risk-adverse retirees, we include a 3 to 5 year ladder of high-quality fixed income investments to handle monthly income needs. For retirees invested in our more conservative portfolios and who are concerned about having money to live on for the next few years, we incorporate a 3 to 7 year ladder of high-quality fixed income investments such as CDs, treasury bonds, or high-quality individual muni bonds. The fixed income protection layer is customized for each individual after determining their annual cash flow needs. Our risk-controlled portfolios are available in 4 distinct risk levels. After a thorough evaluation of your financial situation, together you and I determine what is the correct investment strategy for you. So if you think our risk-controlled portfolios might make sense for you, please give me a call and we can discuss your individual situation. Thank you for your time.